Welcome to the latest edition of The Bull, the Bear, and You as we navigate what is happening in the economy and we take a look at investing. I'm Stacy Smith, and I urge you to subscribe or say that you like this podcast on whatever platform you happen to be using. Well, right now, it seems the markets are digesting the latest world or economic news and then are just shrugging it off and then continue to move higher. Coming up, we'll try to answer the question, why? Also, a great discussion on Wall Street's thoughts and attitude on software stocks. It is coming up in this edition of The Bull, the Bear, and You. And with me to talk about the economy and investing is my panel of financial advisors and experts, and they are Carrie Coghill of Coghill Investment Strategies. Next, we find Frank Rossetti. Frank has his own alternative investment company, HF Management Company. Also sitting at the adult table is Kim Forrest of Boca Capital Partners. And there's one more spot at the table, and that is occupied by Michael Godwin of Fregasso Financial Advisors. Michael is the Chief Investment Officer for that firm. I trust all of you are staying warm and were able to shovel out your sidewalks and the driveways and whatever. That was quite a storm that we had moved through here, and it's going to stay cold for a while, too. So here's hoping you guys did well. Well, a lot has happened in the last 2 weeks since we last met, but after a day or two, the markets just seem to shrug off any troubling news. In fact, the S&P 500 did suffer for the first time since mid-June 2 weeks of back-to-back losses. But as of this morning, it is now setting new intraday highs. So to me, it begs the question, why? Michael, why is this market so resilient and so strong?
I don't know, Stacy. Why are you starting with me? Look, the good news is you're really starting to see a broadening out of equity market breadth, I think. Everybody knows the Magnificent Seven. I've been telling clients this. 2 years ago, every single stock in the Magnificent Seven outperformed the S&P 500, and by a wide margin. Last year, only 2 of the 7 stocks outperformed the S&P 500. And we take a look at the market performance so far in 2026, technology is the third worst performing sector in the market. So you're starting to see a broadening out of equity performance across industrials, energy, materials, all across the spectrum. It's one of the reasons why also you're starting to see significant outperformance in the international markets. You're getting a wide equity market breadth, which I think is great. Kim could certainly talk about earnings and earnings expectations in 2026. They look pretty solid. The consumer is still, we've been talking about this a lot for a while, on very, very solid footing. Unemployment rate ticked down slightly. I mean, for a number of reasons we can get into at some point. But people are still working. Paychecks are still continuing to increase. I get that it's a K-shaped economy for the most part, where the upper echelons of the income cohort are doing very, very well. The bottom, not as much, but the upper cohort are the ones who are really spending the money. And so from an investment standpoint, everything is kind of hitting on all cylinders for the most part. I mean, AI is still in the infancy. You're still seeing those stocks really kind of playing out and continuing the strong performance there. But overall, the economy is still in pretty solid shape. Yeah, you're always going to find pockets or stories of what's not working, but overall, I think things look pretty good.
I think we're at a really exciting time, actually, with the markets. And Michael mentioned it, the broadening out is really exciting. And I think people are, wondering, is the AI trade over? Because as he mentioned, technology stocks are not performing as well. What I would tell you is that I think the broadening out that we're experiencing in the market is the AI trade. When you think about AI and now the demand for AI, you have to extend beyond the companies, right, of the world that are solely focused on the creation of AI to the other things that you need for AI to run, like energy, like data storage. There's so many other industries that now are starting to expand because of AI. As far as other things in the economy, we are still very closely watching employment. Because even though we have seen the numbers kind of on the surface stay in line, there are some reasons to maybe keep an eye on it, such as participation rates, to really know how the health of the consumer and what the health of the consumer really is. So, I don't think that things are bad out there. However, another point that I love that Michael made is this K economy. The whole premise of, the rich keep getting richer and the people that struggle are struggling more. That's an issue. And that becomes more of a, social issue, that if you pay attention to demographics and things like that, it really helps to start to understand and create some sort of foundation for longer term investing. Like, what do these demographic shifts look like as our population continues to age, as that gap potentially is becoming wider? So there's a lot here that's really going on. And you really have to break it down to that kind of short term, less than 3 years, intermediate term, that 3 to 10 years, and then 10 years and beyond.
All right. Kim or Frank, any comments?
Go ahead.
So, go ahead, Frank.
No,
I
go ahead.
want to be the cleanup batter here.
Kim. No, I want to be the cleanup batter.
Oh, okay.
I'm going
So,
to have to be the manager and sort this all out for you guys.
okay. Well, we're not going to play rock, paper, scissors. I'll just go first. So, I agree with what Carrie and Michael have said. I also look at the economy, and I only really look at the U.S. economy. I'm kind of not that interested outside the U.S., but there is definitely a K-shaped economy. And one of the most intriguing things that has nothing to do with a K-shaped economy, I guess, is that we saw productivity grow in the fourth quarter. And everybody's pointing to AI. And I'm going to call not AI quite yet, okay? Yeah, there's probably some people using it effectively in writing or transcribing. I think that's probably okay. But what we really did see beginning in the third quarter and stopping in the fourth quarter was increased firings. Companies were letting people go. It is now 6 years since 2020. The start of COVID was about this time. We began hearing, an illness coming out of China, that whole thing. And what I think companies had been doing was keeping every last employee, regardless of how they contributed to the overall, well-being of a company. And I think they've finally gotten to the point this year in 2020, or last year in 2025, that they've let those people go. And so we didn't have to have a tremendous increase in output, but we had lower labor within the halls of businesses. And I'm going to guess the larger companies let people go more than smaller companies did. And they were able to realize higher productivity. That can't go on. That being said, I'm very optimistic in this next year that some of AI's promise is going to come through and perhaps productivity will grow. And I think we're set up for an interesting year here where we'll have probably shifting leadership in different sectors, which is kind of a relief. It's not all 1 or 2 stocks or 7 stocks. But now we have to be real stock pickers and take a look at those holdings or real asset allocators. What part of the world do you want to be in? What sectors do you want to be in? Because this is going to be back to a dynamic market, not just one winner or loser.
Interesting. All right, Frank, you're batting cleanup.
Totally agree with everything everyone said. And let me add to it. The employment thing that people are worried about, I believe, is a temporary problem. We have, I've said it many times and I'm going to say it again, 10,000 baby boomers a day retiring. That's a lot of workers, all right, that are leaving the workforce. So the participation rate looks good, Carrie, because the number of employees is shrinking because of my generation.
But
And
Frank, just to clarify, we've actually seen the participation rate go down.
okay,
So that's, what you're saying really supports that.
so what you have is you have a shrinking labor force. And we used to fill in some of that with immigrants. That's not happening currently. And who knows if and when that'll happen. The world is against letting people into their country. It's not just a United States thing. We've also have a situation where I think there's a short-term problem, but short-term we have a sell America thing going on, but I think that's temporary. And but you've also have a weakening dollar, which is making our assets cheaper abroad and their assets more expensive here, which is why the international markets have been part of the reason the international markets have been rising. So there's additional things that are going on that are creating distortions in the market, and it's our job to figure out what's getting distorted negatively, and I mean distorted, not because it should, but because of all this stuff that's going on and what is getting hit hard. We all know that defense has gone up dramatically. I can't imagine these companies with their limited production capacity are worth the multiples they're trading at. So that trade's probably over, or at least for now. But there are other things that will evolve, and it's our job to figure that out and pay attention to.
So I'm going to. You brought up about the immigration thing. You are correct. The fact is the United States population is not growing right now because we don't have as many immigrants coming in. I do want to bring this up before we leave this subject, and that is, I mentioned as we got into this that the S&P 500 was setting new intraday all-time highs. It probably, who knows whether it's going to close higher or not, but it looks like it just might do that. But while the NASDAQ and the S&P 500 are up today, the Dow was down triple digits at my last look. In fact, it opened down, I think, more than 400 points or something to that degree. Why the economy between these indices?
Ooh, I have the answer. So the Dow is only 30 stocks. And one of their stocks, which I own, to be perfectly transparent, is called United Healthcare. All of the healthcare stocks got clobbered today. And that is because the U.S. government has decided not to increase the reimbursement rate, especially for the programs that are most used by people. And it's escaping my mind right now. I'm not on Medicare, but
Medicare Advantage.
there we go, yes. And that's where you, generally the participants aren't paying very much, if anything, to be in that insurance. And the company is taking a whole lot of risk about what's going to happen to those covered individuals. But, and they've had very healthy increases in the recent past. That's not happening. So that stock is down by 20% or so right now. And that is why the Dow there could be other elements of it, but 20% decliner is just going to make it look really ugly to look at the Dow.
I presume all the healthcare stocks are taking it on the chin right now?
Yes.
Yeah.
Yes.
Okay. All right.
Yeah,
Well,
and
let's
we
move
also
on.
have,
Go ahead.
in normal times, sometimes we see that divergence kind of as a reflection of interest rate expectations, because when rates are going up, that tends to hurt NASDAQ stocks a little bit more because they're capital intensive, where Dow stocks are maybe a little bit more mature and don't rely on that capital so much.
It's funny you bring up interest rates. That's exactly where I wanted to go next. The Fed announces what it's going to do with interest rates.
Before you go there, Stacy, let me ask Carrie a question.
Sure, go right ahead.
In 52 years, I never saw what I would call normal time. I don't know what normal is. Would you explain?
Yeah. I mean, it's just like, so I've been in this industry now. This year is my 40th year. I have never in 40 years woke up in the morning and said, today's a great time for me to invest in the market. Like there's always something to worry about. Nothing is ever normal.
But you still invest.
But I still do, right?
Yeah.
I understand the value of long-term investing.
Right. Okay. Now can I move on, Frank?
Guys, please.
Okay, thank you. As I mentioned, the Fed is going to announce what it's going to do about interest rates tomorrow. There was a time when everyone was just totally focused on what the Fed was going to do. It doesn't seem that way right now. So, Frank, I'm going to ask you if you can glaze into your crystal ball and tell me what you think about interest rates and where it's going right now.
I think it's pretty well accepted that tomorrow the Fed is going to do nothing. And so the surprise will be if they do anything at all. I don't expect a surprise. The rhetoric has been kind of quiet on that front the last couple of weeks. And I think that with inflation not coming down and employment hanging in there, I think doing nothing is probably the right thing to do for the foreseeable future.
Okay. Anybody disagree with Frank?
Now, the markets are currently projecting a 2% chance of a rate hike this week. So again, next to nothing there. We're expecting, the markets at least are expecting at most two rate cuts in 2026. So again, we're getting to a point where each cut is only 25 basis points. It just shouldn't move the market too much one way or the other. That's why I don't think people care as much. Back, a couple of years ago when rates were kind of all over the place, first to the upside, following 2020, and then significant cuts following significant inflation, people cared a lot more about what the Fed was going to do than they do now, certainly.
Okay, I'm going to move on to something else we've kind of talked about already, and that is that to bolster what you guys have said on this program in the past here, the Wall Street Journal is now reporting, and I use the headline, quote, "Wall Street has fallen out of love with software stocks," end quote. That article goes on to say that there are predictions that 40% of new software business will be created with techniques involving AI bots, translating plain English prompts into usable code. So, Kim, your background is in software engineering. Have you fallen out of love with software stocks? And should investors start to shred some of these stocks on news like this?
So kind of, sort of, but not really is my answer. So for, let's see, for probably 5 years, other than Microsoft, which is its own little spot in the universe, most of the other companies that were really hot, like Salesforce and all those kind of business-oriented software stocks, that's what we're talking about, they had tremendous growth through probably 2020. And most of the growth comes from companies adding seats. So they see the head count, and they're based on head count, okay? And then it depends on what level you're going to buy the product at. So larger companies generally buy bigger, more robust products than smaller companies. If you're looking at Salesforce, which is a customer relationship manager package, helping your sales force manage their business, okay? So that growth has been slowing, which everybody anticipated. And I think at some point it's going to pick up. But right now, as you pointed out, the chill of the AI bot, that people are going to, listen to this is the most ridiculous thing I've ever heard of as a software engineer. I'm taking my investor cap off, putting the software engineer hat on. So a machine is going to write code, and it's going to do it better than humans. But I can see that in a very narrow strip that could be correct. But even humans make so many errors, and it takes so long to release software because of all the use cases that you didn't ever think of when you were designing the product. Now, I think that bots can help these packages get smarter, but the basic use of the product isn't going to go away. People think that, and this is just like any new technology, that they could just speak it into existence. Make me a customer relationship management software from nothing, right? Code it up, and off we go. like the machine's going to do that. I just think that software user interfaces, we'll put it that way, are more complicated than people give them credit. And you can't just hand it off to a bot. So probably this timeline's going to be 18 to 24 months between now and when people go, well, it kind of added some productivity, but it's not doing what we want. It's too hard. I hope I'm making sense, because people will try this. It'll get there 80% of the way, but getting that to 100% of usefulness will need human intervention, not just the bots. How about
So
that?
if I can try to understand exactly what you're saying, what is happening here is that companies have invested in some sort of software already, and it allows them and their workers to say, I want some software that will do whatever they want it to do. Align all my pictures in the right order or something,
Sure.
whatever it might be.
Yeah, whatever.
And so they feel then that, according to this article, some people feel they don't need to buy any more software. They don't need to.
Exactly. They could just speak it into existence or type it into existence, because this thing called Claude, which is Anthropic's product that codes, does a pretty good job, right? Mm-hmm. And I think that's right. But that last 20% is always the hardest. And I don't think you can automate that. I just don't.
Okay, good. Anybody else have comments about this?
I mean, I think it's just such an interesting conversation because, I'm so glad Kim's part of this because a lot of reasons, but she's a software engineer, so she really can speak to it. I wrote code in college, but that was a long time ago, and it's in the museum. So, but the application, so just on a very superficial level, I recently worked on a project using Excel. Well, my knowledge of Excel, I can get by. But this was much more complicated in that I really wanted to take information from over there and put it here and analyze it first. And all I had to do was to talk into ChatGPT and say, here's my spreadsheet, here's where the information is, and here's what I want to do. It wrote all of the formulas for me. And I literally had to do copy, paste, copy, paste. Now, don't tell anyone, but my team here thinks I'm a genius because I pulled this off. But there's so much more. There's so much more we're going to be able to do. And when you have these technologies, I think where we kind of lose sight is that it's going to create industries that we don't even know, we've never heard of before. So, it's kind of, when I talk about interest rates, to tie this back to the last conversation, we always want to say, oh my gosh, what if we go into a recession? What if employment, tanks? And then we want to end the conversation there without saying, okay, well, if that happens, then the Fed's going to lower rates. It's going to stimulate the economy and the economy is going to grow again. So we definitely have to broaden out our vision and our perspective on this.
I think in regards to the hardware versus software, I'm very bullish on the hardware longer term. I think all of this AI demand is creating more and more need for the actual hardware. I mean, I think robo taxis are not in the too distant future, and the amount of hardware that is incorporated into some of these robo taxis and autonomous driving is a ton there. To Kim's point, though, on the software side of things, at some point, that's what makes investing great. There is a compelling argument or buying opportunity for some of these stocks, right? Adobe's down 50% over the past 2 years. Salesforce down 40% over the past year. If they're not going to go away, at some point, it makes it an interesting buying opportunity. So, I'm bullish on the hardware side long term because I think the prospects are there for that. But does it make for a great investment decision versus software? Maybe not, because of how much some of those softwares have been beaten down, and it now looks to be more of a compelling investment opportunity as opposed to necessarily the growth engine of the tech sector.
All right, that leads me to a question that Michael, you just said that, a couple of these companies have taken a beating. They're down 40% or whatever it might be. In the past, all of you have indicated that you really take a look at that the earnings reports and the future of what the companies say they believe is going to happen in their not only industry but with their particular company. So if a company's down 40%, how do you justify going and buying that company if it's not doing well?
Well, what is well?
You're confusing the corporate earnings with the stock market. Corporate earnings have nothing to do with that's not true. Corporate earnings are corporate earnings. It's how well the management of the company is doing relative in their business. The stock market does not always agree with the numbers. Sometimes the stock market gets bogged down with perception as opposed to reality. And I'm not saying that Salesforce or something is going to go up because the perception is wrong, because I quite frankly am not qualified to judge technology. I have to ask Kim those questions. The market is an emotional thing on a short-term basis. It's not based on fundamentals. What happens today probably have more to do with what happens in who says something than the actual reality. And when you talk about interest rates, which we were talking about earlier, for example, everybody wants to focus on what the Fed's going to do tomorrow, which is an overnight rate, period. As power plants get built to feed AI, and as AI gets built to do all this wonderful stuff everybody's talking about, they're going to borrow a lot of money. The demand for money is going to rise. You've got every government in the world borrowing money to build up military because the big brother quit protecting everybody. Okay, so everybody's is kind of more on their own than they were. They're going to buy a lot of airplanes and stuff, and that's demand for money. And I believe when you get out of the weeds from 20,000 feet, interest rates are the price of money, and the price of anything is driven by supply and demand. And if the supply remains static, which it probably won't, but if it does, and demand grows, if demand grows more than supply, the price of money is going to rise. Kim will talk about money supply later. You like to talk about that, Kim.
I do. I love money supply.
No,
Michael, I wasn't
it's a good point,
criticizing what
Stace. I
you were
mean,
saying. I
there's
was
no
just-
universal answer to your question, unfortunately. I mean, and you take a look at Google, Nvidia, Amazon, Facebook. All of those stocks have had 70% or more drawdowns in their lifetime, and that ended up being a buying opportunity. And you take another look at another company, and using this as a purely example, something like Beyond Meat is down 98%, and who knows what the prospects of that are going forward. You know, the former have all rebounded to make all-time highs in the not so distant past here. You have to analyze each and every one of them, and that's kind of what we all sort of do for a living. Kim probably more to a greater extent than Carrie, Frank, and I. But there's no universal answer to that. You have to just, when you see a big pullback, that's when you kind of put on your hat and sharpen your pencil and do the homework on whether now is a good buying opportunity and the prospects look much more promising in the future.
And I will say that is a qualitative analysis. It's about the management team. It's about the strategy. That's really when you have to listen to earnings calls, listen to what leadership is saying, what's coming down the pike, what initiatives do they have. It kind of sways away from what the numbers look like.
What we're doing over here on stock picking side is we look at a company today, its recent or even its historic past, and try to get a story, a narrative, if you will, of what might happen in the future. And I'm not somebody that knows or spends a lot of time on thinking, what the economy is going to be like in the future. I just look at these companies and say, here's what they've done in the past. They identified a core group of clients, customers. They were able to create a product or service that satisfied them. And are they going to be able to continue to do that and return shareholder value? And is it worth taking the risk that they're going to be able to do that in the future? Looking at the software companies, I kind of look and say, a lot of captive data there, which is very interesting to me. It's difficult to move off of one system to another, so that's kind of interesting. And then I say, what people are thinking, and what I was trying to explain, I don't think I did a very good job, that actually making software to do what you want, is really hard, especially if you have 1,000 people beating on it, asking it to do things and not having it blow up. That's a whole different, if you're a software engineer, you know what I'm talking about. But so that's what we're doing, is we're looking far out in the future at all the things that can happen between now and then and deciding, is the risk worth it? And I think for a lot of the software companies, the risk probably is worth it. Not all of them, but some of them. And Michael did a great job at laying out some short-term winners like Beyond Meat. Now 2% of its all-time high. That should be a warning. Maybe it wasn't Beyond Meat. Maybe that's the problem. But no, that we have these cycles where they fall in and out of favor. The thing that I've known, because I've done this now for 27 years, Wall Street's incredibly short-sighted. They're looking maybe, if you're lucky, 12 months in the future. And I'm looking 3 to 5 years. That's the big difference. I'm playing a completely different game than many people on Wall Street.
So we have to end the program here, but what do you mean Wall Street is looking short term, maybe just a year down the road? Are you talking about traders? Are you talking about investment firms?
All of it. I think, that people who are participating in the market generally are more short-sighted, and you could see that in their trades. Who's buying today at what price? Who's selling today at what price? That's what I mean. And because I watch all that activity, and there are as many ideas, because that's what we're talking about. People are having ideas saying, I hate this company, I'm selling it, or it's at its maximum price, or whatever the reason is behind it. We don't know. Somebody else is buying it for completely different reasons, and you're trying to discern why they're doing it. So for what I've seen in the, watching prices and watching things move, Wall Street, the beast that encompasses me and the shorter term people, have generally a shorter term point of view on a trade than I do.
Okay. All right. Anybody want to add anything to that before we close it? Nope. Okay, great. Well, we will continue our look at investing in the economy in future editions. Also, since you're watching or listening to this particular podcast, I ask that you hit the like or the subscribe button on whatever platform you happen to be using. But thanks again for joining us. We'll see you again for the next edition of The Bull, the Bear, and You.